It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast as we dissect the Australian property market together. The journey, it is well and truly underway, isn't it, for 2026? We know market conditions are changing constantly, almost on a daily basis. You got to be on your toes, have your wits about you. Never truer when it comes to the Australian property market. And good morning, Eileen, in the suburb of Chatswood in Sydney this morning. You have emailed through saying that you are a grandmother. You told us that you never thought that you would be listening to a real estate podcast on how to house your daughter, who is on her own with two children under the age of 7 with no home to call her own. You like the idea of a tiny home, you say, and putting that on your section. And currently you've engaged a builder friend of the family to look into all of this. You listen regularly since your daughter put you on to us and said, keep up the real estate stories. Thank you, Eileen. It is a family of listeners and people just like you. We appreciate taking the time out to send us an email. If you listen to us, and especially if you are a new listener, let us know what your story is. Our email address is myrealestatepodcast@gmail.com. Eileen, it definitely sounds like you might be ahead of the curve. It is a Friday, February the 13th. If you're having a birthday today, happy birthday to you. You're in good company. Robbie Williams, the singer, turning 52. Hasn't he always lived at full volume, unapologetically to the absolute max? Now, talking of being pushed, interest rates are back at the centre of the national conversation. Inflation remains persistent, government spending is under scrutiny, and global uncertainty is feeding into the Australian economic outlook. After a period of renewed confidence in property, the recent rate rise has shifted sentiment again. I think it's fair to say that. Borrowers are recalculating, investors are reassessing risk, and buyers are questioning timing. So let's, off the back of that, go to Sydney, where Anthony Landau, the Managing Director of Equilibria Finance, is waiting patiently to discuss his favourite subject and obsession, the Australian property market. And good morning. Welcome into the Friday morning on the Real Estate Breakfast, Anthony.
Great to be here, and a lot of terrain covered there. I'm sure there's a link somewhere between Robbie Williams, Eileen and housing. But look, what Eileen's talking about is not uncommon now. So it's great to have Eileen listening to the podcast. And it's not as unusual as maybe she thinks around some of the planning people doing now with intergenerational homes, getting family members in with all the affordability challenges. In fact, some of the banks are even adjusting some of their policies around granny flats, tiny homes in properties like Eileen. So great to have you with us, Eileen, and keep listening.
Yeah, exactly right. And only a few months ago, very few economists were predicting another rate hike. Now the conversation, unfortunately, has shifted to the possibility of 2. Some are even suggesting, economists, 3 more increases. The data changed, and so did the game plan of the Reserve Bank, especially their tone about what might be coming down the road. How did you make sense of what we have seen since the start of the year?
Yeah, it's a really interesting one, and there's been a lot of discussion around this. And as you say, 2 to 3 months ago, banks, economists were forecasting 3 or even 4 rate decreases this calendar year. First RBA meeting of the year, we've had the first rate rise since November 2023. Look, I think if we look back, the problem stems from maybe the RBA actually didn't increase our rates high enough back when we were on a rate increase cycle. We went up to 4.35% cash rate. A lot of other comparable economies, Canada, the UK, the US, even New Zealand, their cash rate was above 5 to 5.5%. If you look at their inflationary data, it's back under control. Canada's under 3%, the US is under 3%, UK's around about 3.2%. There's a very, very strong argument that rates were never high enough. Back in August, when we made our first rate cut, growth was projected at 1.8%, inflation at 2.6%. Since then, growth's been around about 3% and inflation's 3.4%. So the RBA has really been struggling to get a handle on the economy. The government will not stop spending, which is fueling a lot of the inflationary pressures. And they've just got it wrong fundamentally. And I think we've got more rate rises in front of us.
Yeah, and before this latest rate rise, the housing market had been regaining momentum in several capitals. That supported by improved borrowing capacity. We've talked a lot about that. That's going to be a big talking point for this year. And also the tight supply, well, that just isn't going away anytime soon. Confidence was slowly rebuilding and clearance rates were stabilising. And as we entered this year, how do you view the true position of the market before this policy shift actually landed?
Yeah, there was a lot going on in the housing market. There always is, but we saw some strong growth last year. Through to the 12-month period, December 2025, we had 8.6% growth in the housing market. Now, that's inflationary on its own. The monthly trend was that the rate of growth was starting to slow at the end of the year. We had a lot of government initiatives that were giving first home buyers particularly incentives to get in the market, these shared equity schemes. Demand was strong. Borrowing capacity had increased with the rate drops. Flow of listings remained low. So there was a reasonable buoyancy in the market. The rate of growth was slowing a little bit. Serviceability, deposits, affordability remained challenges, but we had first home buyers, we had investors coming in strong. We had a good, strong platform for 2026 prior to this rate cut.
We are talking to Anthony Landau, our mortgage guru there in Sydney. When we come back, we're going to be talking about buyer behaviour and a little more on the sentiment when it comes to that buying behaviour and market momentum and the outlook. We'll talk about that after this.
Eager to expand your property expertise? Enhance your real estate know-how with us. Every morning from 6 a.m. across Australia, we deliver you the latest property news, commentary and predictions from Perth to Cairns and from Melbourne to Brisbane, 7 days a week.
I do understand that for mortgage holders, this isn't a great outcome. Having said that, what's also not great for them or for anyone else is if inflation remains elevated. Price level has gone up 20 to 25% over the last few years. That's, I think, what's hurting people. We're actually in a really good position. The labour market is really strong and domestic demand is recovery. These are good things, but it's just that we're supply constrained.
And that is Michelle Bullock from the RBA from last week. It is a Real Estate Friday. With me is Anthony Landau from Equilibria Finance, and it's time to have a look at that buyer behaviour. When an unexpected rate rise hits, the reaction isn't always immediate panic, but it does affect confidence. Borrowers start recalculating repayments and some buyers hesitate while reassessing affordability. Now, Anthony, back to you. On the ground right now, what changes are you seeing in buyer behaviour and sentiment?
Yeah, look, fundamentally, when we're in that period of lower lending rates, that increases borrowing capacity, which can contribute to growth, adding fuel to housing demand. It also enables more investors to get in the market because the cost of their funding is lower. So it adds fuel to the housing demand fundamentally in that sort of environment. So a rate hike will have the reverse effect. It may reduce some of the borrowing capacity for those trying to get in the market, which might ease some of the demand side pressures. Even if demand then remains strong or is still in the market, it might shift to other areas. That's what can happen practically from a psychological perspective, which plays a massive role in the housing market. A lot of it's about sentiment. If people are thinking there might be 2 or even 3 more rate increases, they might cool their heels, they might change their decision making, they might look at other markets, or in fact, they might say, let's get into the market now, fueling some demand. That's yet to be seen how buyers are going to respond. But we're having a lot of conversations at the moment now with our clients about what can we do now with this rate increase? How will that affect us in terms of our buying and the regions we're going to buy and our timing?
Now, if that is you, if you're looking at the market right now, as Anthony says, maybe you are going to cool your heels. Let us know. Our email address, myrealestatepodcast@gmail.com. We would love to know what you're thinking about when entering, perhaps for the first time, into the Australian real estate market. Now, Australia still does face tight housing supply, strong population growth and relatively low unemployment, all of which support property prices. Yet higher interest rates inevitably reduce borrowing power. And it's something that, last year was kind of nice to see the curve changing and people getting that bump, that increase in their borrowing capacity. But if further increases eventuate, Anthony, does housing momentum simply slow down, or are we at a risk of a more meaningful correction? What do you think?
Yeah, that's a really, really good question. Just to quickly touch on it, the average loan size in Australia is about $700,000. A 25 basis point rate increase adds about $110 a month to repayments. So that has an impact on households, on borrowing capacity. The biggest sleeper in all of this is our supply. We have got a chronic supply issue. For example, the federal government scheme to build 1.2 million houses in 2025, 65,000 fewer were built than needed. They're more than 80,000 behind their target. We are not solving this supply issue. So wherever we have chronic supply issue, there's a mismatch between demand and supply, which means we're always going to have, I believe, some growth in the market. I think what this will do, it might slow the rate of growth, particularly in less affordable markets, but it might actually shift the rate of growth and increase the rate of growth in some of the more affordable markets, more affordable price points. Maybe some of the urban fringes might see more demand. Some of the regional centres that are commutable, it might lift demand in some of those areas, especially if we see subsequent rate rises. So to be frank, I don't think it's going to have a massive impact on the overall rate of growth nationally. We might just see a shift in where that growth occurs.
All right, good stuff, Anthony. We'll wind it up there on our Friday morning. As mentioned, Robbie Williams turning 52 today. Are you younger or older than Robbie Williams? I've got to say, I am older than Robbie, but he is not slowing down.
Robbie's not slowing down at all, that's for sure. Yeah, I'm a very similar, in fact, the same vintage as Robbie Williams, so it must have been a very good year back then. And he's still going 100 miles an hour, just like we are with a lot of our clients this year.
Listen to expert perspectives with exclusive real estate conversations and supercharge your knowledge base with us.
We know that Canberra over recent years has seen lots of high-rise developments occur. That in itself can help change a price point. It was a minor fall, it was only 1.3%, but as you mentioned, it was the only capital city to record a quarterly decline in unit prices. So it does show that Canberra is kind of bucking the trend nationally.
Median apartment prices have fallen in 19 Sydney suburbs over the past 5 years.
And some of these falls are double digits. And what that really illustrates is there is no one single unit market in Sydney or in any of our major capital cities. The median unit price in Kirribilli sits at 1.3 million and, as you mentioned, is down 23% over a 5-year period. Some investors are actually selling out. Some of these markets do have a higher concentration of investor activity occurring, which can obviously impact supply levels, transactions.
We connect you to the best real estate information across Australia. The Real Estate Podcast.